Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand insights, strategies and tips to help you master the game of building wealth. In this episode, I'd like to talk about the concentration in the Australian share market. Now, our biggest problem is that the top 10 stocks make up about 42% of the market capitalisation of the total ASX 200. So if we invest in a ASX 200 index fund, which I'm a strong believer in investing in low-cost index funds, we are lacking a lot of diversification. If you compare that to the US market, for example, the top 10 stocks only account for about 20% of the market. So in Australia, the top 20 stocks account for 54% compared to 30% in the US market. Notwithstanding that, there's a lot of concentration in just a few industries naturally because of the big banks. 33% of the ASX 200 is invested in financials, whereas it's about less than half that amount in the US. And also importantly, we have almost no tech exposure. So in the Australian market, of the ASX 200 index, only 2.5% is invested in technology, whereas in the US that's about 24%. Obviously they've got some massive tech companies there, and if you believe that technology is going to play a pretty big role in the economy over the next few decades, then I would be suggesting you'd like to have some investment exposure into that sector. Also, in Australia, we have more cyclical industries dominating our market. So about 70% of the market is in what they call cyclical industries. So they're really open to the vagaries of the economy, whereas that's about 40% in the US. And the US has a higher exposure to defensive industries, which typically means lower risk. So what can you do about this? Well, the first thing is stop investing in direct stocks. You know, most investors that have direct stock portfolios that I see might hold 10 to 20 stocks. It's not enough. You don't get enough diversification in the stock market and it's just too risky. Notwithstanding that, what I typically find is if the portfolio is in profit, that profit resides in only one or two stocks. So they've got one or two right. All the other ones have either done nothing or lost money, and your equity, your cash, your capital just isn't working hard enough for you. So firstly, invest in low-cost index funds because just with one single investment, you can have a very diversified investment. The other thing that I'm suggesting is that you can use a combination of products. So you can use an ASX 200 fund, and there's lots around. iShares has one, but you just Google ETFs. And they'll have a list on the ASX website, and there's plenty ASX 200 funds. And BetaShares has a X20 fund. So that is, it invests in not the top 200, well, it invests in the top 200 excluding the top 20 stocks. So it invests in stock 21 to 200 if you like. And if you invest in proportions of, say, 60-40, so 60% ASX 200 and 40% in X20 fund, then you can achieve very similar levels of diversification compared to the US market. So that is, you get a much more diversified portfolio. So in the show notes to this podcast, I've included a link to our website, which includes links to those specific products that I'm talking about. I've looked at the returns and back tested the returns, and they're superior over the long run. Not by a huge margin, maybe 1 or 2%. But if you believe the banks are going to be under pressure, and Telstra's certainly not had a good 12-month share price-wise, then diversifying away from those very specific sectors and those very specific companies might actually not only make sense if you look at historic data, but make a lot of sense going forward. So that's just a little tip. If you're investing in the Australian stock market, think about the concentration risk, and this is just one tip that you can do to avoid that. Bye for now.